Hey everyone, this is Mark Treichel with another episode with Flying Colors. I'm excited to be here with John McKechnie, John McKechnie LLC, formerly of NCUA, formerly of CUNA and credit union guru. He knows a lot about what is going on in Washington, D.C.
How would you get
guru?
That's my business cards now.
That's a technical term. Yeah. John, it's great to have you back on the show today.
Great to see you.
And we're recording this right before GAC. We'll both be there. I believe that I will be publishing this. I'll be publishing this before GAC. Maybe I'll do it on the weekend so that the regular listeners, when they're flying in, can listen to With Flying Colors and the wisdom that we're going to share with the listeners today.
So wisdom.
I just set the bar real high. So
for Mark, there is no short to talk about. You're
right.
I mean, it's what uncertainty is the word of the day for everybody, not just for Washington generally, but also credit unions. We have just an enormous amount of issues that are yet to be resolved. Clearly, the recent changes where the Trump administration has made some pronouncements about certain independent agencies, NCUA included. Although the media coverage has been a bit misleading from our perspective because they don't mention NCUA. And I think we both know that NCUA in the pecking order of the federal regulatory universe, NCUA does not rate as high as some other banking agencies. But nonetheless, there's just a sense that the deck is being reshuffled right now. And I think credit unions should be concerned. The executive order that came out where the president asserts more control over agencies, that's one issue. And I think it's yet to be seen how much of a real change that's going to be. The thing I'm much more focused on and much more concerned about is the consolidation. That could be significant. And I think every scenario I play out in my head, it ends up negative for credit unions. And I'll tell you why.
Yeah, so walk through that. So you're there's discussions out there. Was it Scott has been asked to look at the possibility of consolidation? Could you walk through what it is you've heard relative to that initiative, and then why you're viewing it as a possible losing game in more than one way?
Since the election, there has been an undercurrent, a buzz among people on Capitol Hill and among people who were at the time about to enter the administration. Now they're in the administration, but there was always an undercurrent of, we're going to look at possible consolidation of the regulators. We're going to look at merging agencies. We're going to look at restructuring, whatever terminology they used. You got a sense that they wanted to look at the financial regulatory landscape and make it simpler. And I think the idea, if the Trump people were on the call, they say it's going to be a more efficient and a more cost-effective way to do things. And so, yes, there's been this, like I said, an undercurrent. That broke out into the open last week, where the Wall Street Journal and Bloomberg and other major media began to cover the possibility, based on their conversations on Capitol Hill, that the administration wanted to roll FDIC and OCC into a treasury, a new department within the Treasury. And that's what the Wall Street Journal article, they specified OCC and FDIC. And that's it. That's all they said. I happened to be, I think by good fortune, I was on Capitol Hill the night before that article appeared, and I saw one of Senator Tim Scott's staff. Senator Scott is the chairman of the Senate Banking Committee. And his staff talked more expansively about that. They said FDIC, OCC, they mentioned CFPB, they mentioned the bank supervisory element of the Fed. The Federal Reserve has a bank supervisor in it, and they would peel that out. But this person who knows I work in the credit union world, he also knows I used to work at NCUA. He said, don't think that NCUA and the credit union regulator would escape that just because most of the talk is centered on the bank regulators. And
just because they don't say the wave will take NCUA, if it takes every other banking regulator, the fact that NCUA is not mentioned is an afterthought of the existence of NCUA. It's not we're going to keep them separate.
That's right. And it's not necessarily meant to be insulting or denigrate us, although, and sometimes being small means we're out of the way and not thought of. But in this case, as you allude to, you're going to have a combination. You're going to have a bringing together of similar functions. And again, I'm just genuinely worried and very negative about that for a couple simple reasons. One, if we lose the share insurance fund, the credit unions have maintained, nurtured, paid into, and the industry and the agency have both created a very stable financial backstop for people who deposit their money in credit unions. That would be brought into the FDIC system, and I don't think it would be to our benefit. The bank-dominated deposit insurance fund would most likely just take our money and put into something that's much more suitable for the banking industry and not for us. People who run that are used to regulating and supervising the banking industry. I think it's going to be a no-brainer that our share insurance fund gets sucked in.
Sure.
And secondly, and I think you probably can speak to this better than I can, the actual supervision and regulation of credit unions. You have an NCUA that I know the industry has ups and downs with our regulators, as it should, and any kind of healthy relationship between an industry and a regulator means that you're going to have sometimes some hiccups. But generally, people know that NCUA is run by credit union, is a regulator that looks at credit unions as distinct, unique, cooperative financial institutions. I don't think you're going to have any of that mentality in a bank-dominated regulator.
Yeah, I would agree with that. Plus, the power players at the new agency are going to be from the bank side, not from the credit union side. At the beginning, it's again, presuming this happens, right? This is the worst case of everybody's moving together sometime, probably with a vote to do it within the first 2 years before midterms. And if it goes down this path, but you talk about the exam side of it, I recall the number was either 30 or 35%. And that's if you looked at, pick a number, a $3 billion credit union versus a $3 billion bank, or a $5 billion credit union versus a $5 billion bank, NCUA spends between 30 to 35% less hours examining that institution. So all other things being the same, because under DOGE and under the right sizing of government, there may be less of a footprint ultimately once that dust settles. The burden of being a bank, as far as how many hours the examiners spend there, is about 135 hours for every 100 hours that NCUA spends. And that means 35% more questions, 35% more analysis, more burden on the backs of the credit unions, if indeed that number was to stay the same and everybody was rolled together.
Sure. And then certain regulations that don't pertain to credit unions may come to pertain to, for instance, CRA.
Correct.
Some of the bank secrecy provisions that are more esoteric could be applied to us. I just think in this brave new world, there's going to be a matrix of how to examine institutions, and that's to be a bank matrix. It's not going to have any accounting for the uniqueness of credit unions, the cooperative, not-for-profit structure, the member ownership, et cetera. I think this could be the practical end of what we know as credit unions if it comes to pass. Now, you raised an interesting point a second ago. You said if it happens, there's certain things the president can do with a stroke of a pen, but there's a lot of other things that have to be changed in the law on Capitol Hill. And I think that there's going to be at least an opportunity for credit unions to make our case to our friends on the Hill that this is not a good idea, that do what you will to the banks. If you want to homogenize their system, if you want to homogenize their regulatory structure, go ahead. But credit unions are not banks, and they shouldn't be regulated or insured like them. I will also make an interesting point. I talked to Senator Scott's people who, again, the chair of the banking committee has apparently, although it's not official, but the word is he's been tasked with coming up with some legislative blueprints and by the administration. And I said to the guy what I just said to you, which is we're not banks. And the banks may say we're banks. They're simply not taxed. And I disagree with that. But he did concede a good point, or at least I hope it was a good point, that credit union just treats its members as members and not customers. And he said, listen, he thought for a second. I could tell it got the wheels turning. Just something as basic as that. We have members. We don't have customers. And from that point forward, I think we can at least make a case. If Congress wants to do this, it's going to be a mistake that they're going to regret, because it's going to really deprive the consumer marketplace
And one of there's many strengths, the credit union industry, the credit union movement, whatever you want to call it, that member side of it is part of it. The ability to bring so many people to Washington, D.C. to hike the hill is another part of it. And that's coming up. We're recording this 10 days, 9 days, a certain number, a week and a half away from when GAC is kicking off. I'm sure that's probably some of the things those folks that are going to be visiting, the Dems and the Ds and the Rs, are going to be saying, hey, don't sweep us up in this. We are different. Making this this GAC and perhaps the next one as important of a couple of visits to Washington, D.C. as the movement might ever have.
That's a good point, and I will reemphasize something I've been saying for many years, and that is that the best advocates credit unions have are not those of us who wander around Capitol Hill or at the agency. The best advocates we have are the credit union people who come to town, like you just described. And members of Congress want to hear from them, and they want to hear their stories from back home. They want to hear what impact credit unions make on their communities. And I think in this case, our people will have an opportunity to make a very compelling case for why we need a distinct regulator. And I think they're going to make a strong case on the tax argument.
So let's look at a matrix. NCUA is rolled into another regulator, and credit unions are taxed on this axis, and this axis is they aren't, and they aren't. What are the odds of? I described those axes wrong, but so one combination is they're taxed and they're rolled in. Another one is they're not taxed and they're not rolled in, and one of them is one of those
mixture,
then the other doesn't.
So
how do you see, what is it, law and sausage? Do you see some people are saying, no, we should be rolled in, we shouldn't be taxed, and then the closer you get to the final act is one of those things happens and one of those things does.
For one thing, the law and sausages comment is terrific. People misattribute that to Mark Twain. You didn't, but some people do. Everybody, if they want to make a quote, they usually attribute to either Mark Twain or Yogi Berra. And in this case, it's not Mark Twain. It's actually Bismarck who said laws and sausages are things you don't want to be watch made. Look, I think we're going to win I feel very confident about the tax issue, even though I think there is real danger up ahead. I think that the tax arguments that credit unions can bring to Washington, once Congress focuses on it, they're going to realize it's just not worth really stirring up a political hornet's nest with the credit union system. I think we've got not only economic, substantive arguments, which is that we benefit consumers every day in the way we serve them, and we help I think we help the entire marketplace by being in the marketplace. I think we help drive bank behavior in a better direction. But besides that, I think we also have a political case to make. There's an average of about 220,000 credit union members in every congressional district in the United States. We can sit across the desk from a congressman and say, look, if you eliminate the credit union tax exemption, you're going to raise taxes on essentially 220,000 of your constituents. And that's a pretty daunting thing to put in front of them, especially with Republicans. And I've been very upfront in saying with a lot of Republicans on the Hill, people send Republicans to Congress to cut people's taxes. They don't send them here to raise taxes. And that's exactly what you're going to be doing if you do something to our tax exemption. So let's just start with that even though there's nothing on paper quite yet with the tax reform, I think between now and the end of March, there is going to be at least a draft legislation. Our goal is to try to keep credit unions out of it. The banks are trying hard to put us in it. And I will also unfortunately mention that the two issues I have heard where the banks appear to have gotten some traction with members of Congress are on the credit unions purchasing banks and also some of the stadium naming rights issues. And I don't say either of them with any great pleasure because I think they're both defensible activities, but I can just tell that since last fall, a lot of lawmakers and their staffs who have generally been friendly to credit unions have expressed some concerns and misgivings about that. So we're going to have to make sure we try extra hard at this GAC and other times to make the case as to why those are not reasons why they should do something to our tax exemption. Again, I feel I'm a cautiously optimistic person on this. I feel like when we bring our people to Washington and make our case, good things are going to happen. But this is a tricky environment. And I think the fact that you have a broad tax reform on the table has made it more dangerous. We've heard a lot of people in the Hill say that while they may not necessarily favor our tax exemption, or I'm sorry, they may not favor doing something to our tax exemption, they've all cautioned us to be very vigilant because they're, in the words of one of our best friends, they're taking a 360-degree view of the tax code. Everything potentially could be on the table.
And when they do that final countdown, they have to try and get it as balanced as they can. There's numbers involved. And if they can look at it and say, this will save us X, and it helps us do these other things we want to do.
Right.
And you haven't slowed that roll, that's where it can get real problematic there.
You have to be very basic and just being, it was just the Woody Allen theory of lobbying. Just showing up is 90% of it. And we just have to get our people here. And I feel, and also, let's not think of this as an episode where you come to Washington, you check the box, you go back home. We need to stay engaged throughout. And I'm not even saying just through the middle of the year. I think that a tax bill could be resolved before the summer, but that doesn't mean we can go back in the woodwork if we win. We just have to constantly be engaged and involved. That's been my mantra ever since I worked for CUNA back in the late 80s. It's just political involvement is not an episode, it's a process.
I can't not say this with reference to Yogi Berra. I wrote down my favorite yogiism, which is that nobody goes there anymore. Nobody goes there anymore. It's too crowded.
It's too crowded. Yeah. But he also says predictions are hard, especially about the future. And so you asked me about what's going to happen with all those different possible outcomes.
Yeah.
And I will say I'm nervous about the legislative horse trading that could go on. I think one senior congressional staffer in the last week said something about how the banking trades, one of the bank trades, is trying to shop an idea that we don't tax all credit unions, but just what they call the big mega credit unions. And I guess they're trying to come up with an asset threshold of credit unions over which they're taxed, under which they're not. That concerns me. I don't know. I don't think that's going to get traction, but we have to make sure it doesn't. But that kind of stuff that goes on in the back rooms in the legislative process, we have to worry about that. And again, the other ingredient we're stirring into the pot is that consolidation issue we talked about. What if somebody dangles out the possibility of keeping the regulator independent in exchange for something else? I don't know what I don't know, but these are all concerning possibilities. And again, but we as a movement have been preparing for many years for these kind of situations. Credit unions have invested a lot of time and effort and money into this. This is why we've done it all. But we have to now use it, get to work.
Dust off the playbook and update it and keep the playbook out, like you said. Don't put it back and keep singing that mantra. When you talk about what's big, whatever the word was you used, it wasn't big, but let's only take.
They call them mega credit.
So when they look, if they go, okay, let's figure out what mega is. Sometimes you try and not create new definitions, right? So when someone says, what might somebody say is mega, the first threshold could be 15 billion, those that report to ones. That's an NCUA internal. The second could be the $10 billion CFPB bright line. CFPB is not something anybody's quoting right now in this administration. So maybe the 10 falls away. So then maybe it falls to what NCUA calls as complex, which is 500 million and above. A higher number, you don't want any of them taxed, but a lesser number is better. But once they get into the discussion of that's what we're going to do, then they got to come up with a number, and somebody's going to fall on the wrong side of that. Somebody's going to fall on the right side of it. And there are credit unions that have tried to stay below 10 billion, avoid CFPB, tried to stay below 15 to avoid ones. They'll be doing the same if there's some artificial number that is determined.
You're right on all those counts. Now I've spent a career reminding Congress that a credit union that's 100 million is no different than a credit union that's 100 billion, and that the structure and how the member ownership and how they relate to their members, that's the important thing to think about. So I'm not going to get into a size discussion with anybody.
Yeah, you don't want to go there. It's just a wrong. Yeah.
Well, so I'm very adamant about that. But I would be remiss if I didn't tell your listeners that the banks are trying to start that discussion, and we need to be aware of that. Like I said, I'm guardedly optimistic. I know what credit union people are capable of. I was at CUNA back during the famous HR 1151, which was over 25 years ago now. But that was a great victory for all of us. I was on Capitol Hill as a very junior staffer back in 1986 when the last real challenge to the credit union tax exemption occurred. Credit unions actually were put into the tax bill. You had this grand bargain between Ronald Reagan and Democratic House Ways and Means Committee Chairman Dan Rostenkowski. That was for a few weeks we were in the tax bill. A lot of our people may not remember this, but credit unions really had to fight heck to get out of it, and mounted a pretty good grassroots campaign, if I can remember, being on the other side of the desk. But this is something that matters to credit unions, and I think we're going to rise to that occasion.
Yeah, I think if it becomes about effort, I think credit unions will rise to the occasion, but it's challenging and choppy waters,
Yes.
right? Any other DC things that you can think of? We talked a little bit about some of the orders. NCUA has a hiring freeze. Every agency has a hiring freeze. They're looking at the size of their workforce. That's going to create some exam challenges. What happens in these times? You talk about bank purchases triggering challenges on Capitol Hill. What happens when you have a hiring freeze is the exams become the only thing that matters. So anything that's not exam gets pushed back longer. Right. So making merger decisions, field membership decisions, anything not meat and potatoes relative to the safety and soundness getting the exam done is what they're going to have to be looking at doing rolling forward.
You're right about that. You remind me, CFPB, of course, has been in the news a lot, and it has been in the news for its entire existence. It's a very controversial entity. I think it's overstated when some people say that CFPBs are completely be done away with, because it's in statute, it's in the law. That can't happen without a change in the law. But what I do think is going to happen under the Trump administration is that agency is not only going to become smaller, but I think it's going to become less aggressive towards regulating conduct in the financial marketplace. Yeah. And I think it's going to be also become much more focused on fraud and abuse of consumers, which I think that's healthy. I think, and it's hard for me, I can't imagine even some of the most strident critics of CFPB to say we don't need to police that. Of course we need to police that. And maybe if CFPB becomes more of an enforcement type agency and less of a marketplace police officer, maybe that will take some of the heat away from CFPB. I'd love to see CFPB eventually become a 5-member commission where you have a mixture of Democrats and Republicans. I think you'd have a little bit less of a lightning rod there and a little bit less of a controversial approach. Even the prior director, Rohit Chopra, he was a pleasant guy to talk to, and I think he was an earnest guy. But boy, he stirred up a lot of controversy with a lot of his actions. And I think he knew he was a deliberately provocative person in those ways. And I'd like to see a less inflammatory CFPB somewhere in the future where we have it as a more sober and staid consumer. And really something that can help the consumer when there are problems, but not dictating to a consumer what they can or can't buy.
Yeah, I'll vote for that. And what was it recently? I learned, or if I knew it before I'd forgotten it, that they basically turned the spigot off from the Fed. Right? They said we have enough cash. We don't need any more cash to conduct our essential business, and that is decided by one person who is the director of CFPB, as opposed to it being discussed with a vote of 5 that have both D's and R's on it.
Well, you got to remember that when CFPB was envisioned by a law professor at Harvard named Elizabeth Warren, she wanted it to be insulated from the congressional funding process. And she thought that would mean it stays away from any kind of political pressures. But as you say, now that if you have a director in there who wants to do what you just described, they did it. They turned off the Fed fund. The Federal Reserve, under the law, is obligated to give whatever CFPB wants up to, I think, 12% of the Fed budget. And CFPB's new director said, we don't need the money anymore. I think the outcome there may have reminded some of the CFPB's defenders on Capitol Hill, like Senator Warren, that maybe we do need to get it into the regular process. And that might safeguard its funding in the future.
Sure. No, that makes sense. Yeah, the approach that she thought would keep it away from scrutiny actually made it more subject to it. So,
Yeah, somebody's playing 3D chess.
that's fun. Fun. Well, which goes to I said this to somebody recently. Debbie Matz was a board member, left and came back. Rodney Hood was a board member, left and came back. When they came back, they understood the game much better. Not only did they learn things while they were gone, they had learned things when they were there, right? And I mentioned the midterms. The presidents typically have a 2-year window if they have control. Trump does, to get things done. But they came in knowing what they wanted to get done, knowing where they had been told you can't do that before, and figured out there's got to be a way, and put bright minds on it, and are taking an anvil to some things that last time they thought they couldn't touch. That's
an excellent analysis. I think that the administration this time is much more, they've learned from mistakes in the past. They made assumptions about the bureaucracy that didn't turn out to be true. I hope I don't get people on one side of the political aisle angry at me, but I think they found out that some of the career folks here in Washington were really hostile to what Trump tried to do. And so in the first term, so they tried to stop it. This time, Trump is addressing that by getting rid of some of those people. And I know it's painful and it's a messy situation. And I think you also have the overlay of the COVID, stay-at-home, telework in the backdrop.
Sure. Yeah. Perfect storm. Yeah.
It's everything is now coming together. And this is an exciting time. I'm not going to lie. I like the excitement and the exhilaration. I know it's painful in some ways to go through this, but I got into government affairs and politics when I was just out of college because I like the thrill of it all. And you and I were colleagues at NCUA during the financial crisis in 2008, 2009. And while it was a nerve-wracking time, it was also it was fascinating every day.
Yeah.
Every day.
If you're an adrenaline junkie, you live for some of this stuff. Right. And a lot of regulators, a lot of people that like Washington, D.C., like you and I, do like that adrenaline. So it is exciting times. The dust will settle, and then we'll figure it out.
We will. Next time we'll know more.
So, John, thanks so much. I will see you at GAC, and listeners, come see John and I. We can, if you want to talk about this or anything else. John, I want to thank you so much for being available on short notice here.
Always great seeing you. Take care.
Yep. And listeners, I want to thank you for listening. As always, this is Mark Treichel signing off with Flying Colors.